For years, the buy-sell agreement has been seen as this rock-solid plan. It's supposed to be the fortress that protects your business, your legacy. But what if that fortress you've relied on for decades is actually a ticking tax bomb, just waiting to go off and leave your family with a massive, unexpected bill?
Okay, let's get right into it because this isn't some what if scenario. For thousands and thousands of business owners, the answer to this question right now is a shocking yes. The very plan you created to protect your family could be the exact thing that puts their financial future in jeopardy. And look, this isn't pocket change we're talking about. We're talking about a potential tax hit of almost $900,000. This number is real. It came from a recent landmark court case, and it represents a silent threat that's lurking in countless business succession plans that, on the surface, look perfectly fine.
So what happened? What flipped the switch on decades of standard practice? Well, it all boils down to one single powerful Supreme Court case that has completely turned the world of buy-sell agreements upside down. On June 6, 2024, the U.S. Supreme Court made a unanimous decision in a case called Connolly versus the IRS. Now, let me tell you, when the highest court in the country agrees on something unanimously, it sends a message that is crystal clear. This isn't just another interpretation, this is the new law of the land, and it takes direct aim at one of the most common ways these agreements are set up. So here's the absolute core of the problem, the huge mindset shift. For years, everyone just assumed life insurance was basically cash set aside to buy out a deceased owner's shares. Simple. But the Supreme Court just blew that idea up. The new reality is that those insurance proceeds are considered a corporate asset, and that means the money first gets added to the company's value, making it worth more before a single share is even redeemed. And just to be clear, this isn't some crazy new interpretation. The court's logic was actually super straightforward. From a pure accounting perspective, that cash is an asset on the company's books, just like a building or a piece of equipment. It increases the company's value, which in turn increases the taxable value of the deceased owner's shares. It's that simple and that dangerous. Okay, so enough with the legal stuff. What does this actually mean for your wallet, for your family's inheritance? Let's break down the actual numbers from the Connolly case, because when you see it, it's devastating. All right, so let's start with the basics. In the Connolly case, the business was valued at about $3.9 million. A pretty standard, successful, family-owned company, right? But here's the kicker. The company had a $3 million life insurance policy to fund the buyout. Under this new Supreme Court ruling, that $3 million in cash doesn't just pass through to buy the shares. No, it gets piled right on top of the company's existing value. You can see it right here. The company's taxable value just exploded overnight. And this is where the financial pain really hits. Before this ruling, it was simple. The estate's share was worth the buyout price, $3 million. End of story. But after Connolly, with the business now artificially inflated to $6.9 million, that same share is suddenly valued at $5.3 million for tax purposes. And the result? An absolutely staggering, and what's worse, entirely avoidable extra tax bill of $890,000. So, the big question is, does this affect you? Well, if your plan is what's called an entity purchase agreement, and this is an incredibly common setup where the business itself owns the life insurance, then yes, you are square in the crosshairs of this ruling. Okay, I know that's a lot, and it's scary. It's a huge problem, but here's the good news. This is absolutely fixable. There are smarter, better ways to structure these agreements that can help you completely avoid this Connolly tax trap. We're going to focus on two key strategies that solve this issue. The first is a classic, pretty straightforward approach called the cross-purchase model. And the second is a more sophisticated and flexible tool called the insurance LLC model. So the most direct fix is what's called a cross-purchase agreement. Think of it like this. Instead of the company owning the insurance, the owners insure each other. So partner A owns a policy on partner B, and partner B owns one on partner A. When someone passes away, the insurance money goes directly to the surviving partner. It never, ever touches the company's books. This completely sidesteps the Connolly problem. The catch? It can get messy. Imagine 5 partners. You need 20 different policies. So it really works best for businesses with just 2 or 3 owners. So what if you have more than a couple of owners? That's where a smarter tool comes in, the insurance LLC. You basically set up a separate new company whose only job is to own the life insurance policies. This also keeps the insurance money off the main company's books, avoiding that tax bomb. But it's way easier to manage than a web of individual policies. But, and this is a big but, you can't just slap this together. It has to be set up perfectly by experts to prove to the IRS that it's a legitimate business entity. Look, the bottom line is this. Neither of these strategies is a DIY weekend project. For these to actually work and hold up if the IRS comes knocking, they have to be designed and implemented by a professional team. Your lawyer, your financial advisor, who really understand all the little details of this new world we're in. So, knowing all this, the real question is, what are you going to do about it? Because just sitting back and hoping your current plan is okay, well, that's not a strategy. It's a gamble. Let me just ask you this, straight up. Has your buy-sell agreement been professionally reviewed since the Supreme Court made this decision in June of 2024? If the answer is no, then you are operating with an outdated plan. You're exposing your business and your family to a massive and completely unnecessary risk. And please, don't think there's some template you can just download online. There isn't. The right strategy for a 2-partner tech firm is totally different than what's needed for 5-partner medical practice. It all depends on your specific situation. There is no one-size-fits-all fix. And that's exactly why we're offering a complimentary business succession plan audit. It's a 45-minute session where we'll sit down, look at your current agreement, pinpoint your exact risk under this new ruling, and start mapping out which of these smarter strategies could be the right fit for you. There's no cost, no obligation. It's simply the most responsible next step you can take. The time to act on this is now. You really don't want to wait for that massive tax bill to arrive to find out your plan was broken all along. The only question left is, are you ready to make sure your legacy is protected?